Hi everybody, this is Gary Dean, and this is our nightly video report for Monday, July 18th, 2016. Sorry about not being able to get out the morning notes. I was out of town and got back about an hour ago, so nothing really has changed from what I put out Sunday morning. The S&P was up, Dow was up 15 points. The market looks exhausted right now. And everything is still trading within these bearish patterns. And we've seen these moves before, and they all have ended the same way. And I do believe that this does end the same way. It's just a matter of when does it really, start picking up steam to the downside. So we have the megaphone top pattern, very overbought on the SMI as well as the MACD. And if we look at the 60-minute chart, this is where we have our bearish divergences that have been in place. And it just a 38% retracement from these levels here brings it down to 2033. We haven't had even a 10-point drop. So if this drops some 30 points, or I'm sorry, 40 points, it's going to feel like a market crash. And we know whenever they have pinned the ask and not let the markets go down at all. When it dries up, it's just one of those things that everything is given back at once. And like I said, I don't believe this is going to be anything different. It's more they're just really frustrating any bears out there that are being very impatient. But really what the bears need to do, our first sign is going to be a push through this 2120 area. If they lose that, then we have the moving average at 2096. So these areas right here, this support zone, is important. If they lose that, that's when I see momentum picking up on the downside. And like I said, I'm still believing that we are heading through 2000 and probably coming down into the below, somewhere in the 1950 range. So again, bearish divergences. We've seen this before. Yes, these can drag out. Yes, they could be frustrating, but the thing is that when it finally happens, this is the move. And like I said, I'm expecting the same exact thing to play out with this right here, because it's the same play that they've been running for the last 3 years. Even 15-minute chart, you can just see bearish divergences, bearish wedge. So it's nothing that can the S&P or the markets head higher? Sure, they could. But is it something that you want to buy into? No. I'd rather, any little pop they give, or in really the bulls manner, gap up, because that's the way they move this market higher. You just really take a little piece and just don't really try to put a time frame on things, and just know, it's probably going to happen in a fairly quick manner. So, just on a short-term basis, you can see that 2126 is a support level. Below that, then we start running into that 2111 and 2100 level. So these are, the bears have their work cut out for them. They really do need to start getting, some type of momentum going on the downside. But it may be just a matter of just letting the bulls wear themselves out. And really another thing that just keeps popping out is every day we get these moves higher and we see the institution, the net money flow is negative, and they're selling this. So again, it doesn't mean that it has to drop tomorrow. No, it just means that every single day that they do this, there's just another crack in the foundation. And when it does go, it usually goes real fast. So with that, enjoy the rest of your night, and I will talk to you guys in the morning.